Everybody, just a couple of minutes in now, so my apologies. We're just working on some technical stuff here, as usual. Technical analysis and technical difficulty sometimes go together, so it's all good. We're here now. That's the main thing. Jason, how are you?
I'm good, Rog. Good to be back here again. Some more interesting things to talk about. Talk about these markets. Talk about how we can use aspects of them to maybe improve the way we manage our portfolios. Should be interesting.
Yeah, exactly. So the idea is this today is we're going to talk about volatility, how to measure it, what is it, and how it can help you obviously get out of sticky situations as well. So without further ado, Jason, can you please show our disclaimers, please?
I sure can. So as always, everything we talk about today is general commentary only. And I've got our disclaimer there. So I'm part of Motion Trader. Well, I'm Motion Trader. That's my business. I'm not part of Selfwealth. And so that's my disclaimer up the top. And below there, you can see Selfwealth's disclaimer and all the licensing details. And again, just stating that it's general commentary only. Got to go get your own personal advice.
Exactly. Perfectly said there, Jason. Can't iterate that enough, right? Because obviously sometimes we'll give stocks and they're only just our opinions, right? Doesn't mean you have to act on them. You do have to do your own research on them. Please do so. All right. So Jace, it's still looking pretty bullish at the moment in in our Western markets, that's for sure. So did you want to start off with how the Aussie market's looking?
Yeah. Let's start with the Aussie market. It's been a pretty subdued week after what we've seen over the last little bit of time. So I'll get a chart up, and we'll start by having a look around that. So this is the ASX 200, and so we got the all-time highs about a week ago, and since then the market's just pulled back to where the key level was. The key level's around that 7,600 sort of mark, and I can just compress that. And you can see why it was a key level, because what's capped the market over the last couple of years. So we've just nudged through it. Now we've just come back and just pausing. And the big question is, like, what's going to happen from here? Are we going to get a run of new all-time highs, or is it a case that the market still needs to do some consolidation? Because this is a big run from that October low up to the all-time high. Markets used up plenty of energy to get up there, and as we know with markets, it's not one-way traffic. They zig and zag their way higher. So are we on the verge of like another sequence of highs or some sort of pause? And my feeling on this, and of course it's only a feeling because I don't know, but after looking at price action for a while, my feeling is that I don't think there's been enough consolidation of this rally off the low, and we are still we don't have a decisive breakout yet of this big trade. It's basically a big trading range. The ASX 200 has been in for a couple of years, and having rallied hard, stuck its nose above the level, pulled back a touch. I think maybe there's a bit more consolidation to come. We're still a bit elevated above these moving averages. So this is the 50-day and the 100-day moving average, and often when a market rallies, like you can just see the rally from the November low, we had a good rally, then we had a pullback to the moving average. Maybe we're still due for some more work around these moving averages. All-time highs tend to lead to more all-time highs, but having said that, there's still pauses and consolidations along the way. So whilst I'm overall positive towards the market, I'm just a little bit reluctant to be chasing it up at these levels. And just quickly, I just throw on a relative strength indicator on RSI. So I just find it here amongst my indicators I have a look at. So it's a 14-day RSI, and we looked at this last week. It's still got the divergence there where the market ASX 200's made a new high. So you can see we made a high in January, a high recently, come down to the RSI, made a high in December, and hasn't made a new high recently. So that's what we call negative divergence. It's look, when I look at an RSI, for me, Rod, it's a bit like one of those barometers, people can use to try and predict the weather, and it can give you an idea that there's a change in conditions coming, but doesn't always play out. So it's just one of those things I look at in the background. I'm combining it with other other things, but it's not a be all of end all. I don't think it's warning of a big topping phase, but just maybe that pause in the trend that I've been talking about. And look, the way I'm positioned in all this, I'm long stocks. I've been long stocks for quite a while. I really started getting back into the market around after the low October 2022, building positions, managing positions through this sideways period, adding more stocks over the last few months. I'm long stocks, but I've still got a cash component on the side. I think, look, when we talk about risk, we often think about what's our downside risk, but I think there's also the risk of getting out of a market too soon after a good run. And that's why I'm still long stocks, why I'm positioned in stocks, even though I think there could be some sort of a pause. I don't want to get out too soon because I think the rally could become something bigger if we really start to move out of this big range. So then it's about giving those stocks room to move, using those trailing stops. We can talk a bit more about that later on. And if we do get a pullback, we do come back towards these moving averages, well, that then potentially sets up some new opportunities for to talk about in the weeks ahead.
Yeah. Is it a similar situation in the small caps? This is the Aussie 200. Is there a similar situation in the small caps?
Yeah, it's a similar but different chart in the small caps. It's they've had a good run as well. They're a lot further from their all-time high. Like the all-time high is back in when's that? Back in September 2021. So I think this is a really interesting area. I'm seeing some pretty encouraging signals amongst the small, the mid cap type of stocks, seeing some good performance there. I think this is an area which we could see a rally develop, a good rally continue to develop over the months ahead. It's just a case of if the ASX 200 pauses, you'd expect this to pause as well. But it's looking at the big rally off the 2020 lows, the downside during 2021, and then 22, 23, the sideways period. I think that's I think that's potentially the basing structure, and now we're starting to lift off it. But the lift off phase, it can be a little bit slow, a little bit cumbersome. There's a bit of you can have a bit of chopping and building, and then further extensions. I think it's an interesting area to be looking at, though.
Yeah. No, it's good to see the difference between the top 200 and obviously all the small ordinaries there. So, but what about the US market? How's that looking?
Well, just calling up the S&P 500 here, and look, it's been another series of all-time highs, and this is often what happens when markets make all-time highs. There's not just one or two; you get a whole series of them, which can last for months. Of course, you get the pullbacks and the consolidations as well, but it's more highs tend to over the period ahead leads to more highs, and that's what we've seen. This is actually the strongest upward phase in the S&P 500 since 2021. So you've got to go all the way back to this period following the March 2020 low to get another period which has been as strong, where the markets stayed above the moving averages and had a really good upward period. So it's been a while in between. Just goes to show when things are down and out and gloomy and everyone's getting pessimistic, it's you just got to remind yourself, and this is about mentally staying in the game, that things don't stay down and out forever. That at some point you get a turning point, and that profitable trading periods and investment periods, they do return. We don't know when they're going to return. We're always looking at signs on the charts, looking for clues of where momentum to the downside is dissipating. But just reminding ourselves that when things are feeling pretty ordinary, that better times do lie ahead, and we've been seeing that in the US market. No immediate signs of a pullback. I think the play would be to, if you're long this market, you'd stay long. I think that's where you make the profit by letting those profits run, not taking profit just because you think the market's had a good run. because the thing is, these markets can run for longer and further than a lot of people think possible. I'd find it hard to add new risk, to add a whole lot of risk at these levels. It's like, if I'm in at a good level, I want to let it run, but I probably don't want to be buying at the moment, because I am just wary of big moves do lead to pauses and consolidations. I think there's a strong possibility we do get this move back to the moving averages. It's definitely going to happen at some point. It's just like, where does it come from? Does it happen from near current levels, or does it stretch a whole lot further and then come back to the averages? But at some point, we are going to see these averages retested. So that just makes me a little bit conservative about adding to exposure to the US at this point. But look, as I say, for those in the market, it's a case of let profits run, wide trailing stops, try and see off consolidations, and make the most of your winners.
Yeah. It's like I said it before. It's interesting to see that we're right at the top there, and a lot of the sentiment when I speak to people, they're kind of bullish, but they're cautious as well, knowing that at all-time highs, you never know what can happen from up here, right? So I wonder if in America they're just waiting for the elections to happen there. So I don't know.
Yeah, it's always interesting looking at sentiment when people are. Like, if people are on the sidelines saying, "Oh, look, I don't want to buy because it's too high, it's going to fall," and I'm not in the market, it's often a sign that the market will continue to run. Market doesn't make it easy for us a lot of the time. Like, I remember that happening during June, July of 2020. The market had a big run, and it was getting itself back to all-time highs, and people saying, "Look, it's gone too far. COVID's coming back. There's going to be another crash. I'm not getting in. I'm staying on the sidelines." And that was probably one of those signs to say, well, look, maybe things aren't going to get as bad again, because there's a lot of people waiting for that to happen. So then using that sentiment as a reason to actually stay in the market and let good positions run. And had you done that, let good positions run, they ran for quite a bit further. But you can see all along the way, there's pullbacks to the moving averages. It's not one-way traffic where it just keeps going up week in, week out. So that's just my point here. Like, do we get a retest of the moving averages? Like, could take several months, but then it could continue upwards again, like later in the year. We don't know. It's just looking at possibilities and thinking about how things could play out. But yeah, always interesting to hear sentiment. What are people thinking? What are people doing with their portfolios?
Yeah. All right. What about the Hong Kong market? How's that looking?
Yeah, just a quick look here. Bit of strength last week, and now it's pulling back again. Downtrend still in place. We're below these declining moving averages, so look, nothing has really changed from that perspective. It is interesting just to have a quick look at China, because the Chinese market, like, it's the Hang Seng, Hong Kong stocks you can trade through Selfwealth, can't trade China, but the Chinese market and the Hang Seng, they really do correlate fairly well. Just looking at the strength we've had in the China A50 over the last week, where we got this fairly impulsive looking rally, and just the consolidation over the last week or so looks looks very much like a consolidation of, like, the up move, the consolidation, and preparing for another attempt at pushing higher. It's I think it's still too early, but I think this is one to watch. At some point, this market will make a low. Like, this isn't the time I'd be getting in. We're still below the 100-day moving average. But yeah, it's just is interesting price action to take note of there. Maybe there could be something that appears here later in the year, but let's just see how this one develops.
Yeah, I'm glad you brought that up, actually, Jason, because I was going to ask you about that. I was doing when I was scanning the markets, so I did notice that kind of a break to the top side of that high there, a potential retest, and then a potential could get continuation move, because there's been two sort of higher lows as well underneath there. So, obviously China being now owning part of Hong Kong, part of China. I wonder if this is an indicator of the turnaround for those markets. So it's not to say that it is going to go up, but it is good to start monitoring these things, and it can give people a bit of a front foot, and to start looking at stocks in those markets if they're interested in those markets, obviously, to see one correlated market start turning around before the other. Because then if they can see that, they can go to that other market and start looking for those stocks right that they've got access to. So it's really good that you brought that up, Jason. Thanks.
Yeah, and there's some good ETFs to look at as well around Asian markets, ex-Japan, which gives exposure to the Asian markets. There is an influence coming from China as well. So, and of course, our ASX ETF. So I think it's a space to watch. Maybe we'll keep a bit of an eye on this and come back to this in the weeks ahead.
Yeah, we'll see if the charts can prove us wrong. Exactly. So, or we can prove them right. All right, fantastic. Well, it's good bit of analysis on the markets in general. Let's now move on to our topic for this week then. And we were going to talk about, and this comes off the back of previous sessions. I sort of try and plan things for what are the themes in the chats and whatnot. So thanks, guys, and I'm obviously saying hello to everyone here. If I didn't at the start, thanks for the questions that are coming through. Thanks for the themes. It gives us ideas to talk about. Really appreciate it, and we just hope they keep coming through to keep a show like this going. All right. So we're going to talk about measuring market volatility. First of all, Jason, in your eyes, what is market volatility?
Look, so volatility is a term we hear a lot. It's actually a statistical measure. They measure it. You can actually measure it out mathematically and come up with volatility numbers, and they use those for pricing things like options. So we're not going to go anywhere near all that. That's all too complicated, and it's not what I do anyway. I look for trends. I don't price options, but that's one of the things volatility is looked for. And I think it really comes down to it's about how much. So putting it simply, it's about how much something moves and how quickly it moves. That's volatility, and it can, while you can use it for pricing something like an option, you can also use it to try and look for extremes in a market, particularly on the downside. Downside volatility is one of those things which is interesting in terms of trying to identify where a low could form. And volatility isn't all bad, because you can have upside volatility, which can be great if you're long the stock, where you're getting that strong upward advance coming through. I'll show you. Let me just go to a chart. I'll show you an interesting chart, which you may hear about in the news from time to time. It's an index called the VIX, which is in short for the volatility index for the S&P 500. It's often associated with a bit of a fear gauge as to when we get spikes in the volatility. It's it's a sign of fear or uncertainty in the market, and you get it during big sell-offs. So just compressing this a bit, and you can see over time you get these upward spikes in the market, and that's where you're getting volatility. And what I'll do, let me just compress this a bit. I'll overlay an S&P 500 chart, and that will give you a bit of a visual on what I'm talking about. So there's our VIX indicator down the bottom. Up the top, we've got the S&P 500, and you can see that these rises in volatility are typically associated with a decline in the market. And then, of course, this really large spike was the COVID decline in March 2020. So you can see we had this historic decline and we had this historic rise in volatility. And there are other notable periods you see through history as well, where we do get the volatility. It shows up in the VIX. So the best time to invest tends to be when the volatility is in decline, because the bull markets tend to be more orderly, and prices grind their way higher over time. Like it said, markets climb a wall of worry. They grind upwards, whereas when they fall, they can fall hard and fall fast. And that's where the volatility spikes when they're falling, and the volatility tends to come out of an index when it's rising. So the best time to invest typically is when it's either falling, VIX is falling, or when it's steady. You can get long periods like this stretch during 21, where it was just got to a lowish level and it was just fairly quiet. It was a range-bound period. You see these similar periods where there's not much going on in the VIX, where volatility is low. It tends to be rising markets, and that's what we're seeing at the moment. If I can just increase this scale a little bit, you look at what's happening at the moment. Markets are rising and volatility is low, and they can help you. I think an indicator like the VIX, they can be useful for trying to identify market lows. So I'll put this onto a weekly chart. I'm just going to compress this and get a little bit more data on this one. And yeah, so like I've this highlighted area, I've just highlighted an area between around 35 and 40. It's just, it doesn't have to be precisely there. It could be a bit higher, but just it generally picks up these spikes, and you can see that these spikes tend to mark notable lows in the market. You can just follow them all through. So they don't tell you when. You can never be sure that the market's hit a low point, but when you get a big spike in volatility, which is going through this 40 region, that historically there's a good chance that there's some sort of a low in the making, because you just think about how markets work when there's panic selling. It's a lot of people want to sell a lot of stocks at the same time. That causes a downdraft in the market, which causes a spike in volatility. Once the selling's done, the volatility dies down, and then price often starts to recover. So it's an interesting index to keep an eye on during periods of volatility in the market. But it's like it's not perfect by any stretch. So just looking at this period during COVID, for instance, I might just duck back to a daily chart to look at this. And this is the thing with indicators. No indicator will give you the perfect setup. It's always a case of interpreting and being open-minded as to what could happen next. And so if we were looking at this after the initial COVID decline. So there's the S&P 500. We'd had market had been rallying. We had the initial COVID decline, which was pretty. It was sharp. It was a sharp and it was a concerning fall at the time. You can see how volatility spikes, got up above this historic mark, which often kind of tops it out. And look, it would have been a reasonable case to make that, look, maybe that's it. Maybe the worst has passed. Market began to stabilize, volatility started to come off, and then it really happened. And the volatility went to those historic levels and the market came away. So you've always got to be wary that things can get more extreme. Extremes are a good guide to maybe we're getting near some sort of an important point. But always remember, an extreme can get more extreme. There's no rule on where extremes have to stop. So look, volatility, I think it's an important concept to understand. I don't think you need to have to be able to calculate it yourself, but just understanding it, just like going through what we've just been through in the VIX. And I think a lot of people, they want a nice, they want a smooth upward trend in markets or in stocks, and they want small drawdowns. Drawdowns is where you get to a equity peak, and the market, your stock price comes back a little bit, but doesn't come back too much, goes up again. Whilst we like that, that's just not how markets are. When you look at the VIX and you see all those spikes that we saw through time, and the thing with markets are we can't avoid volatility. Markets are just inherently volatile. It's one of those things, I think, Rog, that I think people who want to get involved, they've got to be aware of that.
Yeah, but no, it's good to be once again, these sessions are a bit about education around different tools and things they can use. And that VIX index is also something that I look at on a daily basis on my scans, just to see if there has been any spikes and if we've got to be worried about just another indicator to see if there's something potentially happening behind the scenes, right? So no, I like having that knowledge of that indicator, right? It's a good one to have. So in terms of stocks, then, how would we measure the volatility on a specific stock?
Yeah, so look, how to use volatility? Well, as we're saying, use it for options, use it for trying to identify extremes. The way I use volatility, it's I do use it for looking for extremes in markets. I use the VIX. I might also use a rate of change indicator that can sometimes be helpful in an index like the All Ordinaries. With stocks, I tend to use it more as a means for managing my risk, and I might actually go to a chart to work through all this. And so it's interesting because a key input for it, I use volatility as a key input for working out my exit strategy. So there's so much focus. Like everyone talks about, when am I going to buy? What am I going to buy? But you don't often hear so much about when people are going to sell and when should you sell. It's often a bit of an afterthought, but I think this is a really important thing because this is where you make your money. You make your money when you sell. So I'm using volatility as part of my calculation for when to sell. So I'm using an example from my own portfolio for this. There's a company called Ridley Corporation. RIC is the code. It's an ASX stock. Could use any many stocks, but I just use this and so this is my entry point, this green circle. So it's up about 100%. And this second green circle, this is the motion trader entry point. This is where it first triggered a buy signal. So the moving averages, just to understand why the buy signal happened, it had been and this is it's always interesting just to review these things. Like why does an entry point happen? Had been a stock below moving averages. When stocks are below moving averages, I'm not interested. Don't want to know about them. There are other stocks to focus attention on. You can just discard them, just leave them alone, wait until they stabilize. Ridley eventually stabilized, started to form a base, started to turn higher, got above the moving averages. The moving averages crossed, so I'm using the 50 and 100 day, not magic indicators by any means. You could use 20 and 30 days, whatever it may be. But for me, I like the 50 and the 100 for my medium-term trends that I'm focusing on. Ridley got above those averages, hit a 70-day high. So that was a confirmation for me there was underlying momentum there. Doesn't guarantee it will continue, but it gives it the characteristics of one of those stocks which can go a long way. So that triggered the signal. I didn't have available capital at this point, so that's why I'm not in there. My entry was later on. I was in other stocks, and then space freed up my portfolio. I got in a bit later. Came back, consolidated to the moving averages. Things we talk about each week. You get an upward move, you get a pullback to the moving averages. Talked about that with the ASX 200 earlier, and that was my entry point. And then the stock kept rallying. So you look at a stock like this, look at a move like this, and go, look, how do you get this? How do you get from this initial entry point to the current high? So this stock from the original entry point's up about 220%. Like, how do you get there? How do you get that move? Because it doesn't move in a straight line, does it? You've got all these pullbacks along the way. So how do you get this move? And I think the first point to make is that you get it by letting your profit run. That's the underlying basis of it all. You've got to let a profit run to get a large profit. And you've got to resist the temptation to be banking small profits along the way. Like, you just think how many people would have got in on the same day how many people would have been selling? Oh, look, I'll take a 10% gain, I'll take a 20% gain, whatever it may be. Cashing out all the way. There's a pullback. It's going to come back to where I got in, so I'm going to sell now. I'm going to lock in my 15% gain, whatever it may be. You can't get 220% if you're short-circuiting your potential all the way up. So that's the first thing. And then the next thing, which is just as important, it's like you've got to be able to see off all these pullbacks along the way. Like let's just draw some of them in, and like all these periods. So if we just highlight a few of them on the way up, these are all periods where the market has pulled back, say, look, we can measure them in the moment, but roughly they're double digit. These are all double digit pullbacks. So say of the makings of maybe 10 to 25%. Get all these pullbacks along the way. So if you're going to get the big gains, you've got to be able to see them off, and you measure them out and say, like, this one here, that's like, there's an 18%, and what's that? That's another 18%. This one looks a little bit bigger. It's 20%, and so on. So you've got to see off these pullbacks. So you think, I want to get this 200% gain, but I've got to sit through a series or a multitude of double-digit pullbacks along the way. I think this is another really important concept to understand, because everyone can see they'll look at this chart in hindsight and see this big sweeping uptrend, but they won't necessarily think about, like, how am I going to ride through all these pullbacks along the way? And these pullbacks could be 30%. And it's interesting, Rod. You can get a stock, you can get a scary shakeout where a stock, I'll just make up some numbers. Say a stock's up 60%, it then has a 30% shakeout, and then within 2 or 3 months, it's at a new all-time high. It's happens a lot, and but a lot of people can't see off the scary shakeout where the price comes back. So this is where one of those areas where I'm using volatility. I'm using volatility to see off these unpleasant periods, but periods which are nonetheless part of the trend, because as we said, markets are inherently volatile, and you've got to accept that. And then come up with a plan to deal with it if you're going to get these gains, because it's not a smooth ride. As we say, it's not a smooth ride to the top. It's bumpy. Now, so what I do, it's trailing stop. Trailing stop is part of my plan, and now this comes down to where we use volatility. It's like using volatility as a key input into that trailing stop. So a trailing stop, for those who don't know, it's an exit point which trails beneath the share price. As the share price rises, the exit point rises beneath it. But the key is how close are you going to have that trailing stop sitting below the share price? Now, a couple of ways to do this. There are a few ways to do it. I'll just go over 2 of them. One is using a percentage-based trailing stop. So you say, look, my trailing stop will sit 10% below the share price. If it comes back 10%, I'm out, or 15% below, or 20%, or 25%, whatever it may be. It's just a fixed percentage. It doesn't adjust to the stock's volatility. It's just a uniform percentage for every stock. It's effective, but just think about, you've got a property trust on one hand, and then you've got a speculative mining stock on the other hand. Their volatility is going to be significantly different. So 20% pullback in one stock is entirely different to a 20% in another. So that cookie cutter percentage trailing stop, it does the job, but maybe not as effectively as this next method I'm going to tell you about. And that's where we use volatility. It's called the average true range of a stock. So the average true range, I'm just like blowing this up so you can see the daily bars. It will measure the width of each trading range. So the day's high, the day's low, and it will measure it over a period of time. So it might be over 2 weeks, over a month, over 2 months, whatever you want it to be. And so then you get you can get an average. You can get an average trading range. And then what you can do, and this is what I do, I'll then apply a multiple to that. You say, okay, I want my trailing stop to be a multiple of the average trading range below the trade's high. So if this is the trade's high here at, say, $2.38, my trailing stop will be, I use a factor of 10. It'll be 10 times the daily trading range, which then might give me a trailing stop down at $1.60 or wherever it may be. And then that will follow the share price up over time. So I can actually put using TradingView, I can actually put a trailing stop on this. So let's just do that. So this is a volatility-based trailing stop. So this is just an inbuilt indicator with TradingView. So let me just set this up. So I use the motion trader entry point, and this one doesn't get very far. It ends after a few days, and that's because it's only using it's a tight ATR stop. So just to show you, I think this is using an ATR of 3. So if you want to use a tight trailing stop, that's great. You're going to shut volatility down. You're going to shut risk down. It doesn't get very far. It runs into trouble after a few weeks. It's too close. If you want to be a short-term trader, maybe you're doing something around that, but that brings its own challenges. That's not for today. We've got to say, look, this got us, only got us 3 weeks in. We need to get this is this entry point is in November 2020. We need to stay in this trend for like 3 years or so to get our 220% gain. No good getting knocked out there. So let's adjust this. So I'm in the settings area for this. So if you're doing this yourself, you go into inputs, and I'm going to go down. So this is the length of time it's measuring over. So it's just calculating the ATR or the average trading range over 14 days. So 2 weeks. That's fine for this. To see the multiplier is 3. I said I use 10. So let's use 5. Let's see what happens if we use 5. We can go through a few examples. Use 5, gets us a bit further. Stays in the trend for what's that? About 7 months. So not bad, but doesn't get us 220%. So let's change it again, and let's make it 6. So just a little bit wider, because so we can say, look, it just nicked the stop there. What if the stop was just a little bit lower? Wonder whether that would have kept us in. And sure enough, 6 keeps you in. And you can see if you're using a 6 ATR stop, there's your pathway to 220%. Well, that's just, the thing with the trailing stop is it never gets you out at the high. So if this is the high now, which we don't know, it comes back, well, it won't be a 220% gain. It will be, what would it be? Just measure that to where the trailing stop is. It would be it'd be 176% gain thereabouts. So you give back some at the end. That's the thing with the trailing stop. You always give back something at the end, but it keeps you in the trade. So maybe this trade doubles again. We don't know. But by giving it room to move, we're giving it a chance to go for a long time. And you think, well, okay, well, I'll show you the trailing stop motion trader uses. It's similar to motion trader stop. So I'm using 10. And so again, it's using volatility, using a multiple of the stock's daily volatility. And so the 10 ATR just sits further back. So it's giving it more room to move. And so someone might say, well, look, why do I want to use 10? Because 6 worked just fine. I don't need to take that much extra risk. 6 was good. So, okay, so we think 6 is good. So let's go back. Let's go back to 6. I'm going to change stocks. Let's change stocks, and we'll use another example. This is another motion trader stock. It's a company called Viva Energy Group, VEA. And now I've just got to adjust where everything is. So the motion trader entry point was back here in May 2021. And again, we've got this nice sweeping uptrend. What's that? It's not quite close up. It's up maybe about 80 or 90%. So it's a nice trend. It looks reasonably smooth when you just take a quick look at it. But let's see, how do we actually manage this one? How do we stay on it? So this is using 6. So I've got the 6 ATR. So 6 worked just fine for Ridley, but in In Viva, the 6 ATR is only getting us about 7 months into the trade. So it's well short of staying into where we currently are. So you say, look, what if we increase that? Increase it to, let's go with 8. See whether 8 does the job. Yeah, still a problem. This is why I'm using 10, because 6 worked well for Ridley, but it's not going to be optimal for every stock. It'll work might work for a lot of stocks, but it's every stock is different, and you can't perfectly fit the stop in hindsight. You've got to get something which you can use consistently over time. So 8 doesn't do the job. So now let's go to the motion trader stop of 10 ATR. That keeps us in. Every consolidation is going to be different. So in the back testing I've done in my real life experience, I can get more big gains more consistently if I give them more room to move. That means accepting volatility. So volatility, people hear the word volatility and they go, oh no, that's not good. But understanding what volatility actually is, and understanding how do we manage it. And we know that markets do have a degree of volatility. Stocks have a degree of volatility. They're going to move around. But if we want to get from entry point to potentially a high exit point, we've got to be able to give them that room to move about. Give them too much, well then you give back too much at the end. Give them too little, you'll get some, you'll miss some. The closer you make your stop, the smaller your maximum gain is most likely going to be, because you really are going to cap your upside potential because you're not giving them enough room to move around. And so look, I think an interesting way that volatility can be used to help people to put volatility on your side, make it work for you by understanding the stock's movement pattern, and then giving it that room to move about.
Of course. No, that's fantastic, Jason. Good examples there, and good demonstration of how to use the average 2 range indicator to measure volatility, especially for the downside, and keep you in the trade. But at this, to get large profits. Otherwise, take you out if it goes south, right? So much appreciated there with that explanation. All right, well, let's have a look at some of the questions that we've got. Thanks for sending a few questions in, guys. And if there's any stocks you want us to quickly look at, feel free to do that as well. There's a question here from Robert. Do you see a rotation from the S&P 500 into mid and small caps? And if so, what would you do in that scenario?
Well, I do think the mid and small caps are a really interesting area to look at for the US stocks at the moment. Whether there's a rotation into them, I don't know. But I do think they're an area of interest. Just looking at the Russell 2000, the US small caps, looking at its price action, like this is something I've been talking about in my weekly strategy session videos on Friday. And we had that initial run. We came back to the moving averages, did some work, and just now we're just breaking up. We're getting close to a new high, so maybe the momentum's returning there. Like the small ordinaries, it's still a bit below that all-time high. And I think there's lots of room for some maybe some outperformance could come into this sector of the market. At the moment, the momentum's in the big caps. And I'm not going to try and pick a top in the big caps because I think that's disingenuous. The trend's up. You've got to let the trend run, and the trend's strong. But yeah, it's this is certainly an area of interest for me. And the ETFs you can play it with. For the Russell, they're really like you've got to go to the US market, which of course you can do through the Selfwealth platform to buy a Russell orientated ETF. But yeah, there's some interesting ETFs that you can use to play this sort of opportunity.
It's really interesting to see this small cap is a similar looking chart to the Australian small cap chart, isn't it? So it's they're very correlated, aren't they? So very
big rally, big fall, sideways consolidation. So it's all pretty textbooky in that sort of sense, where you get the rally, the decline, the base. And if we're going to keep going towards a textbook sort of outcome, then you get the rally again. But of course, it doesn't. Things often aren't that neat. Whether there's some volatility along the way that makes things a bit difficult, and then we got the upward move. But generally speaking, I think there's definitely scope for an upward move to develop from what looks like a basing structure.
Okay, fantastic. All right, let's have a look at a couple of stocks here. Can we have a look at? Well, there's a question once again from Robert, but it's James Hardy. Let's just go to that to start off with on the charts. Have been performing well, but they have reported today, and the market is not happy. I know you are more of a technical and momentum trader, but what do you do about fundamentals?
I don't worry about them. And fundamental people hate me when I say that sort of thing, and they go, "This guy's kidding. He doesn't worry about the fundamentals." It's like, it's not what I'm looking at. I'm not saying the fundamentals don't matter. At the end of the day, the fundamentals are everything. Stock's not going to keep going up just because it's going up in the chart. There's the fundamentals underpin it, but I'm not analysing the fundamentals. I'm analysing the chart action, and other people are analysing the fundamentals, and they're doing what they're doing. It's like, but everything. The chart is a combination of what everyone is doing, and the value guys might be selling JHX, and the growth guys might be buying it. So you're going to have different fundamental streams coming in and doing competing things. I'm just looking at the price action and assessing the movement of what I can see there. So for me, it's like, look, clearly this is a news-related event. That's why a stock gaps to the downside or the upside. Something's come to the market which has caused it to react that way. At the moment, the upward trend's still in place. At the moment, it's coming back to the moving averages. So, I'm just looking back see whether there's an example to draw upon. Look, you can look at these pullbacks during 21, which look like, well, how far are they going to go? And there's nothing exactly like what we've got now. But this market has been extended above its moving averages for a while. We're getting a pullback. So probably a lot of good news has been priced in, and the news that has come out now is it's either the case of buy the rumor, sell the fact. Maybe it's like, well, it's just met expectations, but now it's profit taking, and I'm getting out. Or maybe it's disappointed the market. I don't know. But I'm not buying the pullback at any rate, no matter what it is. I want to now see, like, what does it do from here? Is it going to then this could be part of a sideways consolidation, which then ultimately resolves to the upside, but we'll see that develop in the price action, starts to stabilize around these moving averages. Or it could turn into something else again, where it kind of stalls and then builds up momentum to the downside. So if I was long, I'd still be long because I'm using those wide trailing stops we spoke about before. This would be like using an ATR of 3 or something, and you'd be out, but then you probably would have been out lower down as well. So sum it all up. I've got the wide trailing stop. I'll give it room to move.
Can you put an ATR on that and see what it would look like with an ATR?
Yeah, we can do that. So that's on the default 3. So this has turned up in the motion trader signals a few times in the months past. So just look just where it's come on. That's using a 3 ATR. So if you're using a 3 ATR, you'd be out of this stock. Be interesting just when the moving averages first cross. I don't know what the answer to this is. I'm just wondering whether a 10 ATR would have seen off that pullback we've got there, because this is a big pullback. It may be too big. Oh no, the 10 ATR just sees that off. So feasibly, this stock could have been bought back here and almost a year ago. And so what? That's from around 32 up to so probably maybe 80% sort of level. So if you're using that wide stop, you've seen off that large pullback during late last year, and you're very much still in the game now. This is just really a blip in the scheme of things. But of course, blips can turn into larger things and then extend towards the exit stop, or they can just do nothing for several months, build a new support base, and then rally again. But the advantage of this wide trailing stop is it's giving the stock time. It's not reacting to every announcement which is coming out. It's like things are going to happen fundamentally, but we're just going to see how that shapes the price action in the weeks and maybe months ahead, and respond to what the share price does over a bit more time rather than just one day.
What about CSL? Can we have a look at that one quickly?
Yeah, okay, CSL. Look, it's a similar situation, isn't it? We've got this sharp move down again, probably news related. Just compressing it a bit. It's like a thing to remember with this one, keep in mind, is it has had a big run off the lows without any sort of real consolidation at all. And it is coming up to where you'd expect, like you'd expect resistance points probably up around these previous highs, not far from where it's getting now. So, a big run, overhead resistance. It's coming back to those moving averages. Moving averages are still upwards. So this is what I was saying earlier. Markets don't move in a smooth fashion with small drawdowns. They do introduce volatility, and the drawdowns can be unpleasant. But now I don't know how this one is going to resolve, but it's completely feasible that after maybe a few weeks or a couple of months, it has stabilized without falling much further and is up testing that overhead resistance. Now, that may not happen, but it's completely feasible that it does. So if we get scared out of stocks every time they have a bit of volatility, we'd find it very difficult to stay in a trend that runs for 100, 200, 300% or more. So those gains are entirely achievable, but the only way you get them is by being able to see off volatility and understanding that some volatility will be the end of the trade. Some volatility will be the early stages of a larger decline. We only know that in hindsight, though. So if you jump at every shadow, you won't be staying on the big trends. I think you kind of got to hold your nerve sometimes and go, okay, I'm giving it room to move. I'm going to see how the market digests this over a bit of time and see if it can stabilize and resume the upward trend. That's nice momentum to the upside. This isn't out of character price action coming back to the moving averages. So yeah, it's. I don't think there's a need to go out and buy it today, but if I owned it, I'd still own it. Still own it now.
Yeah, fair enough. All right. There's a question in there about the emotion trader sort of service, but I'll let you contact Jason about that one. I'm not sure if you've done any studies on that yourself, Jason, about the probabilities of the first signal hitting the second and the third. So is it something that you would take offline, that one there?
Yeah. That's I'll confuse people who won't know what I'm talking about. So Carolyn, just send me an email on that one.
Is there any I know this answer myself. The ATR that we show here on TradingView is actually, it's like, because there's always a lot of custom indicators on TradingView. The general ATR that you get on any other technical analysis platform actually comes out as like another chart, right, Jason? Maybe you can explain it to people better. It's like an oscillator sort of thing, right? So.
It's something I don't really look at. It's but yeah, you can get like I'm using the ATR from trailing view to create a trailing stop, but you can get an ATR which is just measuring the average range of a stock, and just as you say, like an RSI sitting beneath the chart, just seeing how the range is either contracting or expanding.
Yeah,
not
exactly.
something. it's not something I use to actually get a signal off. It's more of, for me, I'm using the ATR as an input to create something else, in this case, a trailing stop. But different people will use indicators in a variety of ways. There are probably other applications which I just don't use.
Yeah, exactly. I mean, in terms of other platforms, they generally have, because I've used it in the past, they've had an ATR, like it has like a secondary chart down the bottom, and it'll calculate it in, it'll calculate it, the average true range the same way as a trailing stop would, but it'll just have the dollar amount of what that is over 14, let's say over 14 days, if that's the period. It won't make it pretty like a trailing stop like we've just shown, right? So, but ATR, average true range, is a very, very common indicator that is used across any charting platform. You can just have a look for it, right? Let's have a look at AGL quickly, and I think we'll finish up on that, Jason.
Okay, AGL. Yeah, I don't know what the news out of that was, but something's caused the jump. But for me, it's like it's a no-go zone because it's below these declining moving averages. I'll probably just leave it at that rather than just going on about it. I don't know what's happening fundamentally, but all I need to know is the share price is below declining moving averages. So for me, the odds look better elsewhere. I'd rather buy something which is above the moving averages and moving upwards rather than trying to hope that the low from last week is the final low and now we're going into an upward trend. Like, an upward trend will always bottom below the moving averages, but there can be a lot of false dawns along the way where it looks like you're going to get a new move. Like, just take this period. I just take this period in here, for instance. Got a nice rally into the moving averages, but then look how much further there was to fall. So, who knows what's going to happen here? Got a bit of an upward bounce, but it needs to do a lot more to get my attention as a possibility.
Okay. And what about what is a stock for you this week that's got your attention then, Jason? Do you have one in mind?
It was interesting. I was looking at the 52-week lows. Sometimes I have a quick look at the 52-week highs, 52-week lows, see what's doing what, and just follows on from what we were saying with AGL. So stock hitting a new 52-week low the other day was Linus Rare Earths, and it's interesting because it was such a boom stock. Like, look at through this period during 2020, 2021, into the early stages of 22. It was a boom stock. It was up hundreds of percent. But just shows when the trend turns, you don't want to keep like a lot of people will see that and they'll see a 20% pullback and go, oh look, this is my chance to get in. And it can be if it's pulling back to the moving averages, but once it declines below those averages, the moving averages turn to the downside, you're just best staying away. And this has been I think a dead end for the last year or two, below these declining moving averages. What's interesting is that it looks like there's been a bit of it could have been a bit of a possibility of a basey sort of formation, which never completed. Those moving averages never turned up. Price never turned to the upside. Now we're breaking to the downside of it. So this is one of those situations where if people had been preempting some sort of low over the last year, maybe, I'm sure lots of people were doing this, given this was a boom stock, and there'd be lots of people who were still holding from the boom period, hoping that the boom returns. When something breaks down out of a range, it's really something to be aware of, because it can mean that the stock is going to continue to cascade to the downside, and we end up we look at this in several months and we end up seeing something like price action like that develop. Seen lots of charts that look like that. So I'm not predicting that's going to happen, but that is a risk. That's what I'd be worried about if I was holding this stock. So if I was holding it, I'd be exiting. I wouldn't be in it, because it's, in a downtrend, I would have already cut it. But if I was in it, I was going, well, what am I going to do? What am I going to do now? This is what I'd be worried about. And look, there'll be people who bought really well, who will ride it all the way up and then ride it all the way down. I've heard that so many times. It's such an avoidable thing. This is why you've got to have an exit strategy, I think. So whenever you get in, you've got to say, look, I've got to have a plan to get out, because there's nothing worse than getting an 800% win or whatever it was, and then coming back to zero. Like, who wants to do that? But if you don't manage your downside, you can be almost sure someone's going to do that. There's probably a whole group of people who'll do that, but it's an avoidable thing. Have an exit stop. People worried that, if I sell today, that'll be the low and the thing will go back up. Maybe it will, but you can always get back in. You can always get back in a bit higher. Once the share price has fallen, you can't get out where you would have liked to have gotten out. It's all over. You've got to then you're hoping and holding that things come back and things get worse, and it feeds upon itself. So 52-week lows are an interesting place to sort of see where you probably don't want to be.
Yeah. Fantastic. Good example to finish up on as to why we do need an exit plan for most of our trading and share trading and whatnot. So, Jason, thank you very much for today. And hopefully we will see you again next week. Thanks, everyone, for coming. Be sure to like and subscribe and send any questions or comments or anything you want us to have a look at through. I hope you have a great day ahead, Jace. Thanks, Ash.
Yeah, likewise, Rog. Viewers, thank you for coming along. You make the show possible. If you guys watch it and enjoy it, well, something for Rog and I to talk about each week. So, thanks for joining us.
Exactly. All right. Take care, guys. Bye.